on our last call, there was a question that came up on how we structure our rental properties and how we take payment because we do this through an LLC, but properties are not owned in an LLC. So I just wanted to illustrate this on the board so you can kind of get a visual on how we do this. So we have rental properties that we own, that I own in my personal name. So they're not in an LLC because I bought them as a primary residence. Now, I do have an LLC that is the face of the business for these rental properties. So when someone rents from us, and we do midterm rental, the midterm rental strategy. So when someone rents one, they sign a lease. The lease is between the guest or the tenant and the LLC, not me personally. So um, what happens is the LLC is like the face of the business, and then all the income, the rents are going to flow into the LLC, and then under that, we're going to have the houses that again are all in my personal name. So what happens is the rental income comes in here. Let's say there's $30,000 a month in rental income collected. Okay, so 30K collected here, and that comes in payable to the LLC. But because the LLC is not the owner of the properties, I don't file taxes with that income. So the LLC acts as a property management company, and that's how we have it set up. So we operate it like it's a property management company. And so out of this 30K, we take a 10% fee. So 10% is the fee. So even though the money's coming here, $30,000, and then we're going to take 10% off of here, which is 3K. Okay, so that's a management fee. The 27,000 is then going to flow through to each property, whatever, they're all a little different, but that 27 grand is going to flow through to each property. And then when I file taxes, I do a Schedule E on each property, and that's where the income for the rentals is going to be filed. But it's going to be that rental income less the property management fee, which is at 10%. So this 3K is going to stay in the LLC. So why do we do that? Does that give us any asset protection? No, it doesn't do that. That's not why we're doing this, because the LLC doesn't actually own the property. The reason we do this is by bringing income into the LLC, it gives us other tax benefits that we can take that we wouldn't normally be able to take if we just rolled it all the way through and just collected it directly. So for example, we can pay ourselves out of the LLC at W-2 income. So we could change this fee, but we do 10% because that's kind of the normal and the standard. If the IRS audits us, they're not going to say, "Oh, you're just trying to like funnel through the LLC to pay less taxes." So this is a fair market value. We could probably do a little more because we're doing midterm rentals. We could probably actually bump that up if we wanted to, like 15 or 20%, and it would still be market value. We should probably actually do that. Um, but this $3,000, I now have the ability to run that through the LLC, and I can start taking, other depreciation. So here I got the depreciation on the houses themselves, but now I can buy a business vehicle with the LLC, take Section 179 depreciation, and use the depreciation on that vehicle to offset this $3,000 here. So that's one way that I can do that. Also, we can pay ourselves a W-2 out of the business. That becomes a business expense. It still flows through to us as personal income that we would have to pay taxes on, but the taxes, the actual payroll taxes, normally payroll taxes are going to be about 15%. So you got here, 15% is going to be your payroll taxes. If you're self-employed, so if I just took it down here, I got to pay a self-employment tax of 15%. Now, when you do it as a business, it splits half, 7.5, roughly 7.5% goes to the through payroll, and the employee isn't responsible for that. The other 7.5 is the business that pays for it. So that 7.5% that the business pays is now a tax write-off. If I'm just paying the full 15% as a self-employed individual, there's no write-off for that. It's just that's the tax. If I'm doing the 7.5%, that is now a business expense for the LLC. So I'm lowering my total taxable income by 7.5%. Now, if you only have a couple properties that aren't renting for much, it may not make that much of a difference. It may not be worth going through this, but as you build up your portfolio, if there's enough money going through here, it might start to make sense to do it this way. So that's how we structure it without having the houses in the LLC, because again, they are in personal name. In order to get these into the LLC, we would need to refinance each property and into like a DSCR loan, which is a commercial loan. At that point, we could put it into the LLC name, whether it's this one or another one that the LLC owns, and then it would all shift, all the income, everything would shift to the LLC. But because these were bought as primary residences and we're keeping those loans because they got super low interest rates, this is how we've structured it to still be able to take advantage of some tax benefits on this income. Hopefully that helps.